Hey guys, to all you future homeowners, welcome back to Truth Exposed, your go-to source for real talk about real estate. Buckle up because today we're going to be unraveling the mystery behind the U.S. housing market's wild ride in 2023. So picture this, despite the recent low mortgage rates, home prices are still maintaining their highs, making even the experts uncertain about their housing outlook and some theorizing the idea of a reverse housing crash. Yeah, you heard that right guys, a reverse housing crash that could literally send real estate prices through the roof come 2024 and 2025. Now, in this deep dive, we're going to be uncovering the secrets behind this housing market anomaly. Think limited inventory, a construction lag, and a whole lot of other factors behind this uncertainty. We'll dissect the current state of the housing market and review the conflicting expert opinions on what's to come. Are you holding out for that dream deal or maybe ready to pull the trigger in this housing market right now? Stick with us to hear straight from the housing market economist on whether you should ride the waves or maybe just kind of wait for smoother seas on that home purchase. It's time to decode the housing market's language and make 2024 your year for home sweet home. So here's a quick explainer on the current housing situation right now.
There's one thing that's been a drag, at least a psychic one, on the economic recovery, and that is the housing market. Home buyers are finally starting to see some relief as mortgage rates have fallen for 8 consecutive weeks. The Los Angeles Times reports, quote, the average interest rate on the popular 30-year fixed mortgage clocked in at 6.67% for the week ended December 20, down from 6.95% a week earlier. As recently as late October, rates were 7.79%, the highest in more than 2 decades. Now, compounding the challenge for home buyers is that there are still too few homes for sale, especially around the job-rich superstar cities, so home prices have continued to rise across the country. That combination of higher prices, higher interest rates, and scarce inventory have, for some Americans, made trying to buy a home a fool's errand. It's a scenario that would frustrate anyone looking to invest in their first starter home or a growing family hoping for an extra bedroom or a yard. A lot of first-time buyers feel it's just out of reach for them.
A fool's errand. That's what they call trying to get a good deal on a home in this current market. And honestly, they do make sense. Other YouTube channels are counting on this commercial real estate refinance problem becoming the catalyst for a market correction. $1.5 trillion in debt due in 2025, they say. They say that if interest rates stay higher for longer, more CRE properties or commercial real estate properties are going to fold on their mortgage. And this could lead to a credit crunch, which leads to businesses stopping, people getting fired, mortgages can't be paid, and then we have this whole housing market crash pandemonium. And I'm not really sure how realistic all of this is, especially since the Fed's already talking about interest rate cuts as early as now. So I wouldn't hold my breath for this one, guys, but we're definitely in a very interesting phenomenon to say the least. Some experts call it a reverse crash. I just call it a persistent trend of high home prices. The number of homeowners with low interest rates resulted in an interesting trend. Many would-be sellers are opting to stay put rather than list their homes for sale to avoid taking on a much higher mortgage rate when they purchase their next house. The latest mortgage rate at the time of this video is above 6%. But according to Redfin, 9 out of 10 current homeowners in the US have an interest rate below 6%. 82.4% have a rate below 5%. 62% have a rate below 4%. 23.5% an interest rate below 3%. The lock-in effect is still at play, squeezing an already limited inventory to unprecedented lows. Redfin reports that new home listings, along with overall number of listings, have hit record lows for this time of year. Now, this is intensifying the competition among buyers in certain markets, and it's really preventing any significant drops in home prices. And so basically, high mortgage rates are like a 1-2 punch as they're discouraging both buyers and sellers, and they're discouraging sellers so much so that even the buyers who are out there, they're having trouble finding a place to buy. Redfin's survey revealed approximately 27% of homeowners who are considering listing their homes for sale in the next year will feel a greater sense of urgency if rates drop to 5% or below. And interestingly enough, an impressive 49% of potential sellers, they noted that they would be inclined to list their homes for sale if rates were to dip to 4% or below. But the question is the Fed going to be inclined to bring interest rates down this low? Now, from what I've been reading, we'll probably reach an endpoint of around 5% in maybe a year or two. But 3%? I'm not real sure we're going to see that again. I mean, remember guys, the record low interest rates for mortgages, it happened because of the pandemic. I definitely wouldn't wish a catastrophe of that level to happen again. But hey, and this is a mighty big if. If that does happen, I definitely would be paying attention to those mortgage rates, you know what I mean? Not to mention the fact that even though home prices keep increasing and contributing to overall inflation, it doesn't necessarily mean that people are making more money. Am I right? Instead, more people, they're spending more money. But hey guys, just a real quick word. If you're finding these insights eye-opening and you want to stay in the loop on all things housing market and economic trends, make sure to hit the like button and subscribe to the channel. And by the way, if you own a home, make sure your home is protected. Get your free home warranty quote. There's a link in the description down below this video. It literally only takes about 10 seconds. Now, more on these factors behind this reverse housing market crash. All right, so housing economists have pinpointed 5 key factors contributing to this unexpected resilience of home values. First off, the ongoing issue of still low inventory, it remains a significant contributor to high prices. Now, like I said earlier, homeowners with low interest rate mortgages, they're just choosing to hang on to their properties for dear life. That is, unless there's this noticeable drop in current rates. Now, aside from that, we're just going to be seeing these locked in homeowners further compounding the existing shortage of available homes. Then there's the hurdles faced by the construction industry. Regulatory obstacles, disrupted supply chains, and of course, increased costs, they're all playing a role in suppressing new home construction, making the shortage of housing supply even worse. Demographic patterns, they're also coming into play, with millennials making up a substantial 43% of the housing market now. I think they're the biggest part of this housing market right now. And their preferences for affordability, larger homes, do-it-yourself renovation opportunities, and cost-effective locations means changing the shape of the current housing landscape for everyone. Now, if we add to that the conservative lending practices that banks are adopting right now, people just can't get a loan that easily anymore. That's partly a good thing, but it also means less money available for people wanting to invest in their first home. But if that changes and lending guidelines were to be relaxed, there's the potential for a surge in buyers, putting additional upward pressure on home prices. Now, lastly, the landscape of foreclosures has in fact shifted. Fewer foreclosures, unlike the high rates experienced in 2008 when homeowners owed more than their homes were worth. Strict post-recession financial crisis regulations made this problem less common now, but it's also contributed to the current market dynamics, i.e. fewer foreclosures, fewer homes available. And as far as the bigger economic picture goes, economists are predicting a slowdown but no recession in 2024, coming off of a post-pandemic era that brought more growth than most experts predicted, but also stirred up some serious inflation. It really looks like we're in for a little bit of a slowdown in some business activity. There's a split opinion among economists though. While some are warning of a slowdown, others are leaning toward a more optimistic scenario known as a soft landing. So, milder inflation paired with a gradual uptick in employment, that's the dream for some, or at least the Fed, that is. Now, the predictions about a recession in 2023, they didn't quite pan out. Looking at the cold, hard data this year could go down in history as a pretty decent one, if not a weird one. Unemployment is holding steady at 3.7%, not quite far off from the 3.5% that we had a year ago. And interestingly enough, the annual inflation rate has dropped to 3.1%. Definitely a major improvement from the 7.1% we saw back in November 2022. There's a ripple effect on consumer confidence as well. According to the latest survey from the Conference Board, good economic vibes among consumers rocketed to the highest level since July. Now, while the possibility of a recession is still far from impossible, it's not likely to happen unless there's some major negative shock to the global economy. Think something like a broader conflict in the Middle East with Israel at war against Hamas fighters in Gaza. Interest rates have played a major role in slowing down the economy, and the Federal Reserve is keeping them high to tackle inflation, and it doesn't seem like they're planning to bring them down anytime soon. As of now, credit card interest rates continue to average more than 20%. Meanwhile, mortgage rates are starting to dip a little bit. The average 30-year fixed rate is still hanging around 6.5%, maybe 7%, and it's even higher in certain faster growing regions. Car loans are pretty much in the same boat. The saying goes, interest rates took the elevator up, but they're going to be taking the stairs going down. Meaning that while some Federal Reserve officials are hinting at the possibility of rate cuts next year, don't expect them to drop that much. Basically, brace yourselves for a high interest rate environment for a while. Now, surprisingly, many consumers have weathered this environment and are expected to keep doing so next year. Even though about 60% of Americans are now living paycheck to paycheck, overall, it seems like the US consumer is cooling off rather than retrenching. Now, with all that being said, homebuyers might be tempted to wait and see how much things get better from here, especially since mortgage rates are dropping at their fastest pace since the 2008 crash. But here's the thing. As rates go down, more buyers may decide to enter the scene. And with everyone jumping in at the same time, that could actually push home prices up. Real estate experts are sounding the alarm, advising against holding out for a better deal. Just take a look back to 2020 for a glimpse of what happened last time interest rates took a nosedive. When the Fed started easing to keep the economy rolling during the pandemic, mortgage rates dipped below 3%. And guess what? Home prices shot up. Fast forward to 2024, and things are looking a little bit different. Many housing experts are thinking that mortgage rates won't drop as dramatically. Maybe just below 6% next year from the current just under 7% after hitting 8% in October. Plus, if more homes hit the market, a sudden surge in demand might not drive prices through the roof. Next year could see a thaw in housing supply after this year's tight market conditions. The chief economist at Redfin warned how difficult it's going to be to predict where mortgage rates or home prices go. So I wouldn't count on any forecast from any of those other YouTube channels. In the past, mortgage rates fell because the Fed was cutting rates due to a looming recession. The critical difference now, as we head into 2024, now that we're in 2024, is that while the Fed is planning to cut interest rates, it's not the response to an impending recession, at least, not according to current expectations. Now, if I were you, and I'm not you, and I'm not a financial advisor, nor is this financial advice or anything like that, I'd make sure to stay updated. Good thing we have our financial freedom fan right here on YouTube. Drop your thoughts in the comments section down below. Let me know what you guys think about the housing market and the possibility of a reverse crash in 2024. More financial analysis and updates in the next one, guys. I'm gonna see you there.